Imagine standing on a beach and watching the tide. You may decide where to place your feet, but you cannot stop the waves from coming in or receding. Similarly, in investing, you may choose which stocks or funds to buy, but you cannot control broad market movements. These uncontrollable external factors are called market risks. Unlike company-specific risks that can be diversified away, market risks affect almost every investor and every asset class to some degree. Market risk refers to the possibility that the overall market will decline, leading to losses across most investments. It is also known as systematic risk, and it arises from economic, political, or global events that move the entire market, not just a single stock. Unlike unsystematic risks, which can be reduced through diversification, market risks cannot be eliminated, only managed.
Over 93% of traders lose money in the markets, not because of the market, but because of their mindset. Hi, I'm GC Sharma, founder of Ghar Ghar Investor, former head of financial education at the National Stock Exchange. After 3 decades in the markets, I'm here to help you trade with discipline, not emotion. Welcome to Bounce Back Trader, India's free YouTube learning series for traders who want to bounce back with clarity and confidence.
1. Equity market risk, the risk of stock prices falling due to economic slowdown, poor corporate earnings, or negative sentiment. 2. Interest rate risk, when interest rates rise, bond prices fall. This affects fixed income investors. 3. Currency risk, for those investing in foreign assets, exchange rate fluctuations can impact returns. 4. Commodity risk, changes in commodity prices, like oil or gold, can affect related sectors and the broader economy. 5. Inflation risk, rising inflation erodes the purchasing power of money, reducing real returns. 6. Liquidity risk, in times of crisis, investors may not find buyers for their securities at fair prices. Market risks are unavoidable because they impact entire asset classes simultaneously. During a financial crisis, almost all stocks fall regardless of their fundamentals. In 2008, even strong companies with solid balance sheets saw their shares collapse, not because of internal problems, but because of systemic fear. This means no investor is immune, no matter how careful or skilled. Global financial crisis, 2008, Indian equity markets fell over 50% in line with global markets. Even fundamentally strong companies saw sharp declines. COVID-19 pandemic, 2020, within weeks, markets worldwide dropped 30 to 40%. Lockdowns and fear caused panic selling across all sectors. Rising oil prices, 2013 and 2022, as India imports most of its crude oil, spikes in oil prices weakened the rupee and triggered broad market volatility. These episodes underline that market risks are large-scale and unpredictable. For Indian investors, market risk is amplified by domestic and global factors. Dependence on foreign institutional investors, FIIs, means global sentiment often drives Indian markets. Currency depreciation against the dollar increases import costs, affecting inflation and stocks. Policy decisions like demonetization, 2016, or GST implementation, 2017, created significant short-term volatility. Indian markets are among the most dynamic, with high sensitivity to both local politics and global events. No, market risks cannot be eliminated. However, they can be managed. Asset allocation, spreading investments across equities, bonds, gold, and real estate cushions overall impact. Hedging, using derivatives like put options to protect downside. Diversification across geographies, investing in international funds so global events don't affect the entire portfolio equally. Staggered investing, systematic investment plans, SIPs, reduce timing risk. 1. Overconfidence, believing you can predict or control market risk. 2. Market timing, attempting to exit before every crash and re-enter at the bottom. Most investors fail at this. 3. Ignoring risk, staying fully invested in equities during uncertain times without a safety net. 4. Panic selling, reacting emotionally during downturns, locking in losses. Investors need to accept that volatility is the price you pay for long-term growth. Instead of fearing market risks, learn to live with them by preparing your portfolio. Understand that downturns are temporary and part of the investment journey. The right mindset is not, how can I avoid market risk, but how can I prepare my portfolio to survive market risk and thrive afterward? During the COVID-19 crash in March 2020, investor A sold all his equity holdings at a 30% loss, fearing further collapse. He missed the recovery that followed, where markets hit new highs within a year. Investor B, however, held on and continued SIPs in mutual funds. By 2021, his portfolio not only recovered but grew substantially. This shows that managing emotions and staying invested is the best defense against market risks. Market risks equals systematic risks that cannot be diversified away. They include equity risk, interest rate risk, currency risk, commodity risk, inflation risk, and liquidity risk. Historical crises prove that all investors are vulnerable. Indian markets are especially sensitive to global and domestic factors. Risks cannot be avoided, only managed with asset allocation, hedging, and discipline. A resilient mindset and patience are the ultimate tools against market risk. Review your portfolio. How much is exposed to equity versus other asset classes? Add hedges, consider gold, debt funds, or protective options. Practice SIPs to avoid mistiming the market. Write down a panic plan to prevent emotional selling during downturns. Remember that downturns create opportunities for long-term wealth building.
You've just completed another lesson of Bounce Back Trader. Remember, trade with discipline, not emotion. Subscribe to the channel, share your thoughts in the comments, and continue your journey in the next video. Let's change that 93% story.